This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Home sweet home. Home Depot reports earnings that some call the best in retail, but shares fell. Why weren't the results good enough for Wall Street?
Taking a stand, the CEO of Walmart criticizes the president as more executives leave White House advisory panels.
Flying high, Boeing ramps up production of one of its key products, and investors are hoping for a big payoff. Those stories and more tonight on Nightly Business Report for Tuesday, August 15th.
Good evening, everyone, and welcome. Now, for much of this year, economists had been wondering where the American consumer had gone. Retail sales were tepid, despite an economy close to full employment. But today, that mystery was at least partly solved. In July, according to the Commerce Department, sales at retailers and restaurants rose at their fastest clip since December. Steve Leisman has the numbers and an explanation.
The government's retail sales report today showed that consumers are finally spending in line with their levels of confidence and employment. July retail sales rose 0.6%, the best gain of the year and outstripping Wall Street estimates. A perplexing decline in June retail sales has now been revised away to show a decent gain.
I think the retail sales data is probably pretty important. It was strong. The last 2 months were weak. There were some factors that probably helped to boost sales, one of which was Amazon Prime Day, which helped to concentrate sales in the month of July.
Amazon said its Prime Day sales was its biggest sales day in its history. And the non-store category, which includes e-commerce, showed a strong 1.3% monthly gain. But autos and even department stores did well. That offset declines at gasoline stations. Until today's data, the consumer had been a mystery. Confidence is high, job growth strong, wage growth modest, but ticking up. But the retail sales numbers have been lackluster for several months running now. Today's report changed the picture somewhat. The June revision and the strong July jobs report are serving as support for the forecast that the third quarter is on track for a near 3% gain in GDP. It's still early in the quarter, and the retail data can be revised. The strong July could have been helped by the Amazon sale, and so it might have borrowed from future months. But the ingredients are there for strong consumer spending. It just took the data a little while to catch up. For Nightly Business Report, I'm Steve Leisman.
Well, Americans may be spending more online, but they're also spending a lot at Home Depot. The world's largest home improvement retailer blew past earnings and revenue estimates. Profits were up, sales were the best in its history, and the company raised its guidance for the second time this year. That's pretty good, given all of the trouble facing the retail sector recently. Courtney Reagan has more on what's working at Home Depot.
Consumers aren't buying as much in department stores or at mall specialty retailers, but home is where the spending is.
This is one of the few areas where the consumer is really spending. And I think that goes back to home prices have steadily increased now, so it gives that homeowner consumer confidence to invest in their home. The consumer is clearly choosing to spend in the home improvement category and maybe not spend as aggressively as elsewhere.
Home Depot posts another strong quarter with sales in its key U.S. market especially strong. All departments saw sales increase over last year in all markets. The world's largest home improvement retailer now expects even stronger full-year results. While the do-it-yourself projects and merchandise sales grew, sales to professionals like home improvement contractors again outpaced the DIYers. Sales of expensive items like appliances and flooring were especially strong. Online sales grew more than 20%. Though e-commerce makes up just over 6% of Home Depot's total sales, stores are a key part of the execution. More than 4 out of 10 online purchases are picked up in Home Depot stores.
In this retail environment, and given what we're hearing from other retailers, is absolutely amazing. What's really incredible with Home Depot is that quarter in, quarter out, they put up these type of numbers despite some choppiness in their overall business.
Some analysts question how long Home Depot can continue to benefit from a strong U.S. housing market and home improvement trends. But the company says with a still tight supply of homes for sale and more than 2/3 of U.S. homes at least 30 years old, there's still a lot of opportunity for home repairs and updates. For Nightly Business Report, I'm Courtney Reagan.
Well, despite those strong results, Home Depot shares fell. Go figure, the stock dropping more than 2.5%. And that made it the worst performer in the Dow index today. So why weren't these results good enough for Wall Street? We just heard from Oppenheimer's Brian Nagel and Courtney's story, and he's back with us now. Everything seems to be working beautifully, Brian, at Home Depot. Why did the stock go down today?
Well, there's an easy answer, and today was just a very, very tough tape for retail stocks. So while Home Depot, and I said my segments before, I thought Home Depot's results were really good. There were a couple other retailers, maybe a few more retailers, who reported really bad results today. And
so a baby bathwater kind of thing, right?
That's exactly right. And it's just the tape was very tough for retail stocks today.
You know, that's interesting that you should say that, because I read in my notes that you say Home Depot was one of the best run retailers in the world. Is it just that the street gets too picky? And I understand that the retail sector as a whole has been under pressure this week and last week for that matter. But is the street getting too picky about some of the internal components of the report?
Well, I think that's a big piece of it. I think there's the other real big piece is everyone that invests in retail stocks right now is really worried about the overall impact of Amazon. So you're seeing retailers that have been clearly impacted by Amazon. And then I think you have a retailer like Home Depot, which is not. But from an investment standpoint, you start to wonder, does at some point Home Depot start to feel the effects of Amazon?
And your answer is, to the question, can Home Depot be Amazon? Your answer is?
Well, the simple answer is no. Now, look, I've studied retail for a long time, and I've watched Amazon for a long time, so I've learned to really never dismiss Amazon. But I look at Home Depot. I think this is Home Depot, and really the home improvement category is really one of the best defended areas within retail against Amazon.
You know, we're using Home Depot as the example, but there are other stocks where the results have been very good and the street sells it off for a variety of reasons. As an individual investor, should you evaluate the pros and cons of a company irrespective of Wall Street's reaction to a report?
Well, look, in my view, that's what gives you the opportunities, right? So in the way I always say to our clients, and I primarily speak to institutional clients, but also some of our retail clients, is look, fundamentals first, right? Look at the fundamentals, analyze the fundamentals of this company. Is the company performing? And then worry about the stock price.
Quick answer here. Where's the stock today? Where do you see it in a year, and how does it get there?
Well, I've got a $178 price target, and the stock today is just about $150. So I expect some still decent upside here over the next 12 months for Home Depot.
Brian, thanks very much. Appreciate it.
Thank you.
Brian Nagel with Oppenheimer.
More positive news for the housing industry. Home builder sentiment bounced back. A monthly index from the National Association of Home Builders rose to its highest level since May. Builders say they are seeing rising demand from buyers who seem ready to pay a premium for new construction.
Factory activity in New York nearly tripled to a 3-year high. The Empire State Manufacturing Index rose thanks to an increase in new orders and shipments. Hiring also picked up, and according to the survey, factories are optimistic that conditions will continue to improve over the next 6 months.
Those positive reports on two key sectors of the economy, housing and manufacturing, were not enough to give stocks a lift. Earnings results from retailers, in addition to Home Depot, also capped any gains. The Dow Jones Industrial Average was up 5 points to 21,998. The Nasdaq lost 7, and the S&P 500 fell 1.
In Washington, the nonpartisan Congressional Budget Office reports that health care premiums will soar 20% next year if President Trump ends the Obamacare subsidies to insurance companies. They are expected to rise about 25% in 2020. The payments help low-income Americans afford their plans. The report also says that the federal deficit would increase by about $20 billion per year over the next 10 years. The president so far has not committed to continuing the payments.
At a news conference today at Trump Tower, the president signed an executive order to speed approvals of permits for the construction of highways, bridges, and roads. This is part of the administration's proposal to spend $1 trillion to fix the country's aging infrastructure. The president said the new process will happen without harm to the environment.
Great to be back.
Meantime, the CEO of the country's largest private employer, Walmart, took the unusual step of criticizing the White House today. In a note to employees, Doug McMillon said the president, quote, missed a critical opportunity to help bring our country together by unequivocally rejecting the appalling actions of white supremacists. A Walmart spokesman told the New York Times, however, that Mr. McMillon will stay on a presidential advisory council on economic development. In the past 24 hours, several more CEOs and business leaders have resigned from the president's manufacturing council in the wake of what critics saw as a tepid White House response to Saturday's violence in Charlottesville. That violence left one demonstrator and 2 Virginia state troopers dead. About 20 were injured. Under Armour CEO Kevin Plank said he decided to leave because his company, quote, engages in innovation in sports, not politics. Intel chief Brian Krasanik left to call attention to the serious harm our divided political climate is causing to critical issues, he said. Scott Paul, the head of the Alliance for American Manufacturing, said he was leaving because it was the right thing for him to do. Yesterday, we reported that Merck CEO Ken Frazier quit because he felt a responsibility to take a stand against intolerance and extremism. The president today in a tweet said, for every CEO that drops out of the Manufacturing Council, I have many to take their place. Grandstanders should not have gone on. Jobs.
At that infrastructure news conference we just mentioned, things got heated when questions turned to the recent events in Charlottesville.
I think there's blame on both sides. You look at both sides. I think there's blame on both sides, and I have no doubt about it, and you don't have any doubt about it either. And if you reported it accurately, you would say.
Joining us now in Washington is John Harwood. John, is this going to spawn more CEO resignations or comments?
Yes, this is going to increase pressure, Sue, on CEOs to separate themselves from President Trump. I'd expect more and more of them to be looking at the admonition from former Treasury Secretary Larry Summers today when he said all CEOs should leave these presidential advisory councils because they're ineffective and they're associating themselves with a president who is not uniting the country.
Does the president have a budding problem with business?
He does. He has a budding problem with the American people. Look, his ratings are below 40% job approval. In Gallup yesterday, he hit a record low of 34%, 61% disapproval. So that's the backdrop. But more specifically, many people in business have been accepting things that they didn't like about Trump in the belief that he was going to be able to do things that they did like. Deregulation, tax cuts, that sort of thing. All of these things become more difficult the more toxic Donald Trump gets on a personal basis, and that is exactly what today's press conference is going to, a problem that's going to make worse.
Do you expect comments from either or both sides of the aisle about some of the comments that the president made at this news conference, and how badly, if at all, do you think it hampers his ability to put through the agenda that you just mentioned?
If people feel embarrassed or ashamed to stand with their president, it makes it much more difficult for them to advance common priorities. Republicans are still going to be for tax cuts, whatever President Trump does. But the more toxic that he becomes in a political sense, the more difficult it is for them to work with him. And that imperils the entire Republican agenda. And frankly, Sue, it imperils the survival of the Trump presidency because he needs protection from people in his party as Robert Mueller's investigation picks up steam. There's the potential for, if Democrats are able to retake the House of Representatives, that there'd be an impeachment drive against him. And so I think the president is making his problems more difficult with every passing day. He did over the weekend. He did again today.
All right, John, we'll leave it there. Thank you. John Harwood in Washington.
Still ahead, Boeing is flying high.
I'm Phil LeBeau at the Boeing plant in Renton, Washington. Why is Boeing the best performing component in the Dow this year? We'll explain what's lifting the company to new heights when Nightly Business Report returns.
Which stock has helped lift the blue chip Dow index to new highs? Boeing. Shares of the aerospace company have climbed more than 50% this year. A big reason for that increase is Boeing's rising profitability in its commercial airplane division. Phil LeBeau reports from Boeing's 737 assembly line in Renton, Washington.
The pieces are coming together in Boeing's push to build and deliver more planes, now cranking out new 737s faster than ever. After building 42 a month earlier this year, Boeing has raised production by 5 per month and will increase it another 10 per month over the next 2 years.
What it really is about is flow management. So, for instance, if we have to push the airplanes out quicker, then how do we sequence the jobs for the mechanics and the engineers to assure that they've got the right tools, the right parts, the right paper to make sure that they can manage this increased flow.
Boeing's not only building planes faster, it's become more efficient. How? It's trimmed the payroll while increasing automation, a combination that has fueled a surge in productivity.
Over the last 15 or 18 months, they've generated about an 11% improvement in revenues per employee at the commercial business. That's well above national averages for productivity gains, and I think they are finding that it's infectious.
With deliveries of the 737 MAX just taking off, Boeing is focused on cutting into a backlog that now totals more than 3,800 planes. That means airlines ordering a new, more fuel-efficient 737 MAX won't be receiving it until well after 2020, which is why airlines are now pushing Boeing to build these planes even faster, beyond the top target of 57 per month.
Even as we think about the rate 57 in 2019, there's upward pressure on that rate past 2019. And so the only way that we can actually conceive about getting to those rates is assuring that the automation augments the workforce that has to do this job.
Lifting the 737 to new heights on the wings of workers moving quicker and more efficiently. Phil LeBeau, Nightly Business Report, Renton, Washington.
Advance Auto Parts had its worst day ever, and that's where we begin tonight's market focus. The car parts retailer said it faced industry challenges in the latest quarter, causing income to slip and miss estimates. Revenue was in line, but the company said it expects same-store sales to fall as much as 3% this year. Shares plunged 20% on the session to $87.08. Coach's decision to exit many department stores due to heavy discounting resulted in fewer sales in the latest quarter. The company missed revenue expectations, but its earnings did beat estimates by a penny. The company also gave disappointing full-year earnings and sales guidance. And what happened? Well, you know what happened. The shares were down 15% to $40.64. After reporting weaker than expected same-store sales growth, Dick's Sporting Goods said it would ramp up promotional efforts in a bid to attract more shoppers. In the latest quarter, the retailer struggled to get customers excited about its apparel offerings, and that caused earnings to miss the mark. Dick also lowered its guidance for 2017, and shares got crushed, falling 23% to $26.87.
Sticking with retail, TJX, the parent company of discount retail chains TJ Maxx and Marshalls, said a rise in customer traffic helped earnings and sales beat estimates. The company also lifted its profit outlook. Shares of TJX rose fractionally to $70.16. According to a regulatory filing after the bell yesterday, conglomerate Berkshire Hathaway sold its entire position in General Electric, while also picking up more than 17 million shares in the GE spinoff, Synchrony Financial. Shares of GE were off nearly 1% to $25.14. Meanwhile, Synchrony Financial shares jumped more than 4% to $30.99. A federal judge ruled that Costco owes Tiffany nearly $20 million for misleading customers by selling engagement rings labeled as Tiffany that did not actually come from the jeweler. Costco argued they used the word Tiffany to describe the ring's setting, not the brand. Costco shares fell a fraction to $156.88. Shares of Tiffany were down almost 3% to $88.11.
China is doubling down in its war of words with the Trump administration. The issue is trade. Today, the world's second largest economy said the U.S. trade investigation that President Trump ordered yesterday would violate international rules. Eunice Yoon has our story from Beijing.
The Chinese government is taking a tough position. The Commerce Ministry reacted to the Trump directive by saying that the U.S. should strictly observe trade promises and not become a destroyer of multilateralism. The ministry warned the U.S. that it should act cautiously on the trade investigation and said Beijing would absolutely take measures to defend its rights if the U.S. harms bilateral ties. The Chinese state media has been threatening retaliation, and today the state-run news agency Xinhua said that the probe would have lose-lose prospects, calling it a unilateralist bearing of fangs that would hurt both countries. The question now is how seriously the U.S. should be taking this tougher tone. Analysts tell me that it's hard to tell, particularly because it's a political season in China. China is heading into a party congress and is expected to see a leadership reshuffle in about 2 to 3 months. Everyone's expecting President Xi Jinping to consolidate and centralize his power, and the way the government has been responding and reacting to outside forces has been with nationalism. Take, for example, the South Koreans. The Chinese have been using strong language towards the South Koreans over its U.S. anti-missile defense system, and even more aggressive language when talking to the Indians about a border dispute in the Himalayas. So this rhetoric could be aimed at a domestic audience as much as an international one, and analysts say that we're just going to have to wait and see towards the end of the year whether or not that tone changes. For Nightly Business Reports, I'm Eunice Yoon in Beijing.
Coming up, can Americans take on more debt and save for retirement at the same time?
Here is a look at what to watch tomorrow. The first round of NAFTA renegotiations get underway with President Trump meeting with leaders of Canada and Mexico. The minutes from the latest Federal Reserve policy meeting will be released. Investors will look for clues on the prospect of future rate hikes, as they always do. And more retail earnings are due out. We'll hear from Target and L Brands, the parent company of Victoria's Secret, and that's what to watch Wednesday.
Household debt is at a record. A new report from the New York Fed shows total debt hit more than $12.5 trillion in the second quarter, marking the 12th consecutive quarterly increase. The increase partly reflects renewed confidence in the economy, but there are some signs that households are becoming overstretched, including a growing percentage of credit card balances that are 30 and 90 days delinquent.
While debt is rising, a new survey shows that a growing percentage of working Americans are saving more for retirement. According to Bankrate.com, 23% of working Americans increased their retirement contributions over the past year. That's the highest level in 6 years. Greg McBride, chief financial analyst at Bankrate.com, joins us now to discuss these survey findings and more. Greg, welcome. Good to have you back. I'm always curious when I hear surveys like this, 23% of working Americans increased their retirement contributions. Is that empirical fact, or is that what they say they did?
Well, that's what they say they did.
Okay.
So, there's always a little, you have to allow for a little bit of fibbing there. But what's unmistakable, Tyler, is that we have seen tremendous improvement in this over the last several years, consistent with an improving economy. Back in 2011, when we looked at this, it was 2 to 1 people cutting back their retirement contributions rather than boosting them. We've seen that swing completely around now to the point where 23% are actually increasing those contributions, and the percentage of people that haven't contributed at all, either this year or last year, the lowest we've seen in that same period of time.
That's the good news. I'm a little bit worried about household debt being at a record and some longer than expected payment times on credit card debt. Does that worry you at all?
Well, it tells us, it gives us a signal, Sue, I think, in the sense that, it shows there are households that are stretching that rubber band further and further. And, this comes at a time when we're near full employment. So that tells me that, unfortunately, these delinquencies, particularly for people that are living close to the edge, they're only going to get worse, that, they're not likely to get better. So I think that, for people that have good credit, they're going to find that credit is still freely available. but that issuers are going to be much more selective with those that have some spots on their credit because of the increase in delinquency.
Okay, I'm going to ask you to channel your inner Susie Orman here for a minute, Greg, okay? If I have to choose between paying down high-rate debt or putting more money into my retirement account, which do I do first?
Well, people ask me this question all the time, and the answer that I give them is do both. It's not a matter of either or. You've got to pay yourself first, have that money go into the retirement account directly from your paycheck, have a direct deposit from your checking account into your IRA, and then you live on what's left. And what's left, you've got to be able to carve out room for debt repayment. And if that means driving Uber or taking on some contract work or a second job, then do it. But you can't afford to miss out on the years of retirement savings in the name of paying down debt. But at the same token, a lot of people have an overhang of costly debt that they just never seem to make any headway on.
Right. Now, and to your point, there are different types of debt that are out there. We pointed out this survey about credit card debt, but one of the worrisome factors that's been out there has been auto debt, and the loans are much longer. Used to be you could only finance for 3 or 4 years. Now they're going out, I think it's 7 years. Is that a warning sign or not?
Oh, I think it absolutely is, because as you noted, not only is the amount that people are borrowing increasing, that they're stretching it out over longer periods of time. We've been at a time when wage growth has been really sluggish for a lot of people, and there's no give. A $500 car payment's a $500 car payment. You've got no wiggle room there, so that's the concern that I have.
Greg, thanks very much, and thanks for channeling your inner Susie. Earlier, we talked about whether there could be more resignations from the President's Advisory Council. Tonight, we are learning that the AFL-CIO President, Richard Trumka, has stepped down.
And that is it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody. We'll see you tomorrow.